China has just done something the United States feared for decades, and it was not a shot fired. It was not a military threat. It was not a speech at the UN. It was something far quieter, far more dangerous, and far more final. China sold U.S. Treasury bonds. And if you do not understand why this is more dangerous than any aircraft carrier, then this video will completely change how you see the world. Let me explain something that very few people truly understand. When a country sells U.S. Treasury bonds, it is not simply moving money from one place to another. It is sending a message. It is saying in the silent language of global finance that it no longer trusts the dollar, that it no longer wants to act as Washington's banker, that it prefers to hold its wealth in something else, in gold, in yuan, in real assets, in anything except promises printed by the Federal Reserve. And when that message is sent by China, the largest foreign creditor of the United States for decades, then this is not a small signal. We are talking about a financial earthquake whose aftershocks we are only beginning to feel. I have spent years studying the mechanics of global economic power. I have analyzed debt crises, currency collapses, trade wars, sanctions, blockades, and I can tell you with complete certainty that what is happening right now between China and the United States has no parallel in modern economic history. Not since Nixon abandoned the gold standard in 1971, not since the petrodollar agreement was signed with Saudi Arabia, not since the collapse of the Soviet Union. What we are witnessing is the slow end of a system that has dominated the world for more than 50 years, and most people have no idea it is even happening. The idea I want to share with you today is simple but devastating. China did not sell those bonds because it needed the money. It sold them because it no longer needs the United States. And that difference separates a normal financial adjustment from the beginning of the end of dollar dominance. But to truly understand what this bond sale means, you first need to understand how the mechanism that kept the United States as an economic superpower for decades actually works. And here is the key point. This mechanism is not based on American productivity, not on innovation, not on industrial strength. It is based on something much simpler and much more fragile. It is based on trust. Imagine you have a neighbor who lives in a huge house, owns 3 luxury cars, takes 5 vacations a year, eats at the best restaurants, wears the best clothes, and one day you discover that this neighbor does not earn enough to pay for any of it. You realize everything he owns is financed by credit cards, but not normal credit cards, a special card where he decides how much credit he has. And when the bill arrives, he simply prints more credit. That is how the United States works. That is how it has worked for half a century. The country consumes more than it produces, imports more than it exports, spends more than it collects in taxes, and finances the difference by issuing debt. Treasury bonds that other countries buy because they trust that the United States will always pay. Here is the trick. The United States always pays because it can always print more dollars, and the world accepts those dollars because they are the global reserve currency. It is a perfect loop, one that has allowed the United States to live far beyond its means for generations. And for decades, China was the main financier of that lifestyle. Every time an American bought a television made in Shenzhen, the dollars paid ended up in the reserves of the Chinese central bank. And instead of storing those dollars away, China invested them in U.S. Treasury bonds. It was a system that benefited both sides. The United States received cheap financing for its deficits. China gained access to a massive export market and a seemingly safe place to store its reserves. But this system had a fatal flaw that few wanted to admit. It gave the United States enormous power over China. If Washington chose to sanction Beijing, it could freeze those assets. If it decided to print trillions of dollars, it diluted the value of China's reserves. If it chose to weaponize the financial system, China was exposed. And China, which may be many things but is not foolish, slowly realized it was financing its main strategic rival. It was lending money to the very country that surrounds it with military bases, threatens it with tariffs, tries to block its technological rise, and speaks about Taiwan as if it were an endangered democracy rather than a rebellious province. This is where the story becomes truly interesting. For years, Western analysts mocked the idea that China could ever sell its treasury bonds. They said it was impossible. They said China needed those bonds just as much as the United States needed China to buy them. They claimed selling them would be financial suicide, that the value of China's reserves would collapse, that Beijing would be shooting itself in the foot. But those analysts made a critical mistake. They assumed tomorrow's world would look exactly like yesterday's. They assumed China would always need to export to the United States. They assumed there was no alternative to the dollar. They assumed Washington's financial power would last forever. And if you think it stopped there, it did not. While Western analysts were laughing, China was quietly building something else, patiently, carefully, piece by piece. It was building an alternative. First came bilateral trade in local currencies. Deals with Russia to pay for gas and oil in yuan and rubles. Deals with Brazil to trade in reais and yuan. Deals with Saudi Arabia, the same country that signed the original petrodollar pact, to consider selling oil in yuan. Each agreement alone seemed small, but together they formed a clear pattern. The world was beginning to trade without dollars. Then came the financial infrastructure. China created SIAPS, its own international payment system, an alternative to SWIFT, the Western-controlled system the United States has used as a weapon against Iran, Russia, Venezuela, and any country that challenges its interests. With SIPS, China can move money across borders without passing through systems Washington can monitor or control. Then came gold. China has been accumulating gold reserves at a pace not seen in modern times. The Chinese central bank buys gold month after month, and it is not alone. Russia does the same. India does the same. Central banks around the world are buying gold like they have not done in decades. And gold has one key advantage that treasury bonds do not. It cannot be frozen, it cannot be sanctioned, and it cannot be printed. Gold is real, physical wealth that does not depend on the goodwill of any government. Finally came the digital yuan, the ECNY, a central bank digital currency that allows instant transactions without relying on dollar-based correspondent banks. A currency China is already testing in international trade with countries along the Belt and Road, with nations looking for an alternative to the system dominated by Washington. All of this was happening while the West was distracted by tweets, elections, and political scandals. All of this was taking shape while headlines focused on everything except the quiet transformation of the global financial system. And when China finally decided the moment had arrived, when it judged that it had enough alternatives, when the risk of continuing to finance its rival outweighed the benefits, it did what everyone said could never happen. It sold U.S. Treasury bonds. But here is what almost no one understands. This was not a desperate sale. It was not an emergency liquidation. It was a carefully calculated strategic decision. China did not dump all its bonds at once because that would have crashed prices and destroyed the value of its own reserves. Instead, it sold slowly, steadily, month after month, year after year. The numbers are public and they tell a story most people still refuse to see. Anyone can see this in U.S. Treasury data. At its peak, China held more than $1.3 trillion in U.S. Treasury bonds. Today, it holds less than $800 billion. That means China has cut its exposure by more than $500 billion. $500 billion that no longer finances the U.S. deficit. $500 billion that is now going into gold, into yuan, into infrastructure, into loans to African and Asian countries that now owe favors to Beijing instead of Washington. This creates a brutal mathematical problem for the United States because the U.S. government did not reduce its spending. In fact, recent deficits have been enormous. Trillions of dollars in pandemic stimulus, trillions in military spending, trillions in subsidies for the tech industry, trillions in interest on existing debt. The United States needs someone to buy its bonds more than ever, but its main buyer is selling. And China is not alone. Japan, the second largest foreign holder of U.S. treasuries, is also cutting back. Saudi Arabia is diversifying. Gulf countries are looking east. European central banks are buying gold. The entire world is making a quiet bet against the dollar. Not an aggressive bet, not a massive sell-off that crashes the system overnight. A slow, careful, methodical bet. The same kind of bet China made. And here comes the question no one wants to ask. If foreigners stop buying U.S. Treasury bonds, who will buy them? The answer is simple and frightening. The Federal Reserve, the U.S. central bank, the same institution that is supposed to control inflation and protect the stability of the dollar. If no one else buys government debt, the Fed will have to do it. It will have to print money, create dollars out of nothing to buy bonds no one else wants. This has a technical name that economists know very well. It is called debt monetization, and it is the path every declining empire has followed before its currency collapsed. This is not theory. This is not speculation. It is already happening. During the pandemic, the Federal Reserve bought more Treasury bonds than at any other time in its entire history combined. The Fed's balance sheet, which was under $1 trillion before the 2008 crisis, grew to more than $9 trillion. $9 trillion created from nothing, used to buy government debt and keep interest rates artificially low. The result was the highest inflation in 40 years. Prices exploded for food, gasoline, rent, and everything people need to survive. But inflation is not the only problem. The deeper problem is the loss of trust. The dollar works as the world's reserve currency only because the world trusts it. Trusts that the United States will manage its economy responsibly. Trusts that the Fed will not print money without limits. Trusts that U.S. Treasury bonds are the safest investment on earth. Every time the U.S. uses the dollar as a weapon, every time it freezes another country's reserves, every time it prints trillions to fund its deficit, that trust weakens a little more. What China understood before anyone else is that U.S. financial power is like a blank check the world signed 50 years ago. A check Washington has been cashing again and again, assuming the day would never come when the world said enough. But that day is approaching, not with a dramatic explosion, but with slow reductions, with every bond China sells, with every trade deal done in yuan, with every ton of gold added by a central bank, with every country that decides there might be another way to do business that does not depend on Washington. The dilemma for the United States is that it has no good options. It can keep printing money and accept higher inflation. It can raise interest rates to attract bond buyers, but that would push the cost of its own debt to unsustainable levels. It can cut spending, but that would mean cutting the military, cutting subsidies, cutting social programs, something politically suicidal. It can try to force other countries to keep buying its debt, but that would require a level of pressure that would only speed up the flight from the dollar. It is a slow checkmate. There will be no dramatic moment when someone declares the death of the dollar. There will be constant erosion, steady decay, like a building with damaged foundations that still stands, but leans a little more each day until one day, without warning, it collapses. Let me explain the scenarios serious analysts are discussing. One scenario is negotiation. The United States accepts a new international monetary order similar to what was discussed at Bretton Woods in 1944, but updated for the realities of the 21st century. A system where the dollar remains important but no longer dominant, where IMF special drawing rights or a new unit of account replaces the dollar as the global reference, where China and other powers have more influence in international financial institutions. This would require humility and long-term vision that Washington has not shown in decades. The probability is low. The second scenario is prolonged resistance. The United States refuses to accept the decline of its monetary dominance. It uses every tool available to punish those who move away from the dollar. Harsher sanctions, pressure on allies to avoid trading in other currencies, possibly even military conflicts to keep control over oil-producing regions or critical trade routes. This scenario is dangerous because it turns an orderly transition into chaotic confrontation. Given Washington's history, the probability is medium to high. The third scenario is a hard landing. Debt keeps growing, foreign trust keeps falling, and political paralysis prevents reform. Together, these forces create an acute crisis. A moment when Treasury markets freeze, interest rates spike, and the Fed must choose between defending the dollar or saving the economy. This would resemble Argentina in 2001 or Greece in 2010, but on a scale never seen before. The impact would be global. The probability is hard to measure, but it grows every year. Deficits remain unsustainable. The fourth scenario is gradual fragmentation. No dramatic crisis, but no real solution either. The international system splits into monetary blocks. A dollar block centered on the United States and its closest allies. A yuan block centered on China and its trading partners, possibly other regional blocks. A world closer to the period before World War II with several competing currencies and none clearly dominant. In my view, this is the most likely outcome, a messy but not catastrophic transition toward a multipolar system. And what does all this mean for you? I know talking about trillions of dollars and Treasury bonds can sound abstract. It can seem like something that affects bankers and governments, not ordinary people. But that is a dangerous illusion. Every part of your life is tied to the global monetary system. If the dollar loses value, prices rise. If the United States pays more interest on its debt, there is less money for public services. If financial markets become unstable, jobs disappear. If supply chains break apart, goods become scarce. There is no escape from this reality. There is no way to fully isolate yourself from this. It does not matter where you live. It does not matter what kind of work you do. And it does not matter whether your savings are in dollars or in any other currency. The financial earthquake that is beginning will shake everything. What China did by selling those bonds was not an act of aggression. It was an act of self-protection. It was the rational choice of a country that looked ahead and decided it did not want its national wealth held by a rival that has clearly shown it is willing to use the financial system as a weapon. It is the same choice any careful person would make after realizing their bank is in trouble. Take the money out before it is too late. The deepest irony is that the United States created the conditions for its own decline. Every sanction imposed on another country was a warning to everyone else that their dollar assets were not truly safe. Every time Washington froze the reserves of Iran, Venezuela, Afghanistan, or Russia, it sent a very clear message to the rest of the world. If you challenge us, we can do this to you as well. The world paid attention and began searching for other options. And now those options exist. Some people argue that none of this really matters because China also has serious problems. Its real estate sector is struggling, its population is aging, and its economic growth is slowing down. All of that is true, but it is a mistake to believe that the decline of dollar dominance depends on China being perfect. This is not about China being better than the United States. It is about the world no longer depending on a single country. It is about diversification. It is about choice. And today, there are choices that did not exist before. U.S. Treasury data shows this trend with brutal clarity. Foreign countries hold a smaller and smaller share of U.S. debt. The Federal Reserve holds more and more of it. Central banks around the world are buying gold at record levels. Trade agreements using local currencies are spreading rapidly. The yuan is being added to the reserves of an increasing number of countries. None of this means the dollar will collapse tomorrow, but all of it means that the extraordinary privilege the United States has enjoyed for half a century is slowly coming to an end. And when a privilege of that size ends, the consequences are never small. The United States built its military power on the ability to finance massive deficits at very low interest rates. It built its diplomatic influence on control of the global financial system. It built its standard of living on the ability to consume more than it produces. All of this depends on the dollar's role as the world's reserve currency. If that status weakens, everything else weakens along with it. What we are witnessing is not just another financial headline, it is the closing of an era. The system created after World War II, the system in which the United States acted as the banker of the world, the referee of global trade, and the source of the currency everyone needed, is reaching its limits. Not because of a secret plot, not because of a direct attack, but because of the natural results of decades of abusing privilege, of wars paid for with debt, of sanctions that taught the world not to trust, and of a money printer that never truly stopped. Let me end with something I believe is important. Many people will hear this and feel fear. That fear is understandable when facing uncertainty, but change is not automatically bad. The current system has benefited a small group enormously while keeping much of the world at a disadvantage. A multipolar world where no single country can create wealth out of thin air and force others to accept it could be a fairer world. More complex? Yes. More uncertain as well, but possibly more balanced. The process I have described is not resolved by a newspaper headline, not by an election, and not by a speech. It is resolved through the slow movement of trillions of dollars across the global board, through decisions made by central banks in Beijing, Moscow, New Delhi, and Brasilia, through trade deals signed far from cameras, through tons of gold crossing borders, and through each country deciding one by one that it no longer wants to place all its eggs in the dollar basket. China sold those bonds, and by doing so, it did more than protect its own interests. It showed that it can be done. It showed that the emperor has no clothes, that the system once seen as permanent and unbreakable has deep cracks. And when a truth like that becomes visible, when the world realizes the mountain was not as solid as it looked, everything changes, not suddenly, not with a dramatic announcement, but in a way that cannot be reversed. My advice is to pay attention. Do not get distracted by the daily political noise. Understand that the forces shaping your economic future are not found in televised debates or weekly scandals. They are found in central bank balance sheets, in international trade flows, in BRICS meetings, and in bilateral agreements that never appear on the evening news. Think about what this means for your country, for your job, for your savings, and for the future you are trying to build. If this analysis helped you, share it with someone who needs to understand what is really happening in the world. Information is the only tool we have to navigate periods of change, and the times ahead will demand that we all stay very alert.